Okay, let's just jump right into it. Welcome to this explainer. Today, we are literally unlocking a vault. We're going to look at how an elite, institution-only asset class finally broke cover and made its way to the everyday investor. For decades, Wall Street kept some of its absolute best income-generating tools firmly behind closed doors. But guess what? That door is wide open now, and we're going to explore exactly why retail portfolios are rapidly shifting to capture the AAA ETF. Picture this. It's before 2020. If you wanted the high yields and the structural protections of the CLO market, you were faced with a staggering exclusivity barrier. I mean, how do you even invest in an asset class that essentially demands a $1 million cover charge? Because that was the reality. You needed millions in capital, deep institutional ties, and accredited investor status just to get a seat at the table. It was the ultimate VIP-only market, leaving everyday retail investors entirely on the outside looking in. Now, to really understand the massive appeal here, we don't want to get bogged down in textbook definitions, but we absolutely need to understand the engine driving this thing. Think of a collateralized loan obligation, or CLO, not as some risky junk bond, but as a highly engineered cash flow engine. It's backed by secured first lien corporate loans. And the secret sauce? It's the tranche system. The cash flows get divided up based on risk and return. These are incredibly complex, finely tuned structures where the top AAA tranches always get paid first. If anything goes wrong in the underlying loans, the lower levels absorb the losses way before that top tier even feels a scratch. The contrast between how it used to be and how it is now is just staggering. For years, direct CLO tranches demanded $1 to $2 million minimums in this opaque, highly illiquid over-the-counter market. Complete headache. Compare that to the ETF wrapper of AAA. Today, you can buy in for roughly $25 a share, enjoy daily liquidity, and access the whole thing right from your standard brokerage account. It is a fundamental shift in accessibility. It completely changes the game. So what exactly was the turning point? Well, 2020 happened. The Alternative Access First Priority CLO Bond ETF, ticker symbol AAA, pioneered the retail market. It basically acted as the key to that vault we were talking about, becoming the very first CLO ETF to launch. By breaking down those massive million-dollar minimums and wrapping these incredibly complex institutional assets into a simple, single-ticker ETF, the playing field was permanently altered. Finally, retail investors had a way in. And the proof of capital preservation really is in the performance numbers. While traditional core bonds, like the U.S. Aggregate Bond Index, were just getting hammered by rising interest rates over the last few years, AAA held its ground. A hypothetical $10,000 investment in the AAA ETF climbed steadily, pushing past $12,700. It's a clear track record of steady income doing exactly what it was engineered to do. But if we're being honest, for income seekers, the core reason everyday retail investors are flocking here comes down to one thing: the yield premium. AAA CLO ETFs have recently been delivering typical yields in the neighborhood of 5.8 to 6.5%. Now compare that to traditional AAA corporate bonds, which usually sit around 4 to 5%. You're capturing a significantly higher return than similarly rated traditional corporate debt. But, and this is the crucial part, you aren't sacrificing that coveted top-tier AAA credit quality to get it. That paradox is an absolute massive win for a fixed income portfolio. And here is the kicker. A huge part of AAA's retail appeal is just sheer efficiency. The fund stands out with a remarkably low net expense ratio of just 0.19%. In a world where specialized, actively managed alternative funds routinely charge exorbitant fees, sometimes 0.5% or even more, this incredibly low cost means that more of that attractive yield stays exactly where it belongs, right in your pocket, working for your portfolio. So when you put it all together, the appeal for the everyday investor is pretty undeniable, right? You're getting strict capital preservation alongside a really powerful inflation hedge, which comes from the underlying loan's quarterly resetting floating rates. Add in immediate diversification across 30 or more holdings, the convenience of daily liquidity, and the ironclad structural protection of those top-tier tranches we discussed earlier, you end up with a total package that traditional fixed income simply cannot match. Okay, I hear you. It sounds like the perfect solution. But to be a truly informed investor, we have to pause and ask the hard questions. Are CLO ETFs actually safe? Now, we know the underlying AAA tranches have virtually zero historical defaults in over 30 years. But wrapping them in an ETF introduces its own set of mechanics and market realities. We really need to pull back the curtain and look objectively at the risks involved here. You absolutely have to factor in the ETF wrapper mechanics before adding this to your strategy. For instance, prices can detach from the net asset value, meaning you might end up paying a premium or selling at a discount. You also face mark-to-market volatility. Listen, during massive market panics, CLO prices will drop significantly, even if the underlying loans are perfectly healthy and paying out. You also have to watch out for spread widening, which can cause NAV swings. And crucially, do not ignore the tax drag. Distributions from these funds are taxed as ordinary income, not qualified dividends. While we're on the topic of risks, it is vital to clear up a common retail misconception that trips a lot of people up. CLO ETFs are not leveraged loan ETFs, apples and oranges. While direct leveraged loan ETFs hold riskier, non-investment grade debt directly without any safety net, CLO ETFs like AAAs are heavily shielded by those structural protections, subordination, and AAA-rated credit quality. Because of this, the default risk for AAA CLOs is extremely low, whereas direct loans carry a moderate default risk. They are completely different strategies. So, how are savvy investors actually deploying this information out in the real world? Well, many are swapping out 10 to 30% of their core traditional bond allocations to capture that yield premium, all while keeping their credit quality super high. And to neutralize that tax inefficiency we just warned about, they're smartly shielding these assets inside tax-advantaged accounts like IRAs. Ultimately, they're using AAA as a rock-solid conservative anchor in a much broader, multi-tiered income ladder strategy. It's genuinely wild how much the landscape has shifted. By utilizing the ETF wrapper, the financial playing field has been fundamentally altered forever. As institutional-grade CLOs continue to reshape our retail portfolios, handing us better yields and structural safety, it brings up one incredibly exciting question. What heavily guarded financial vault are retail investors going to unlock next? It is amazing how this democratization is working. I really hope this explainer gave you the insight to understand exactly why retail investors are choosing AAA and how you can approach it smartly. Keep learning, keep questioning, and I'll catch you in the next one.